All right. Hey, everybody. Welcome to another Ask Me Anything. And we're going to go ahead and go around the horn here in just a moment after this brief message. All right. Welcome, everybody. Go ahead and get those questions into the chat box. Otherwise, we're going to see Linus do something fun, right?
Yeah.
We'll get him one day to do something. But yeah, go ahead and get those comments in the chat box here, and we'll go ahead and go around the horn here. So everybody, I'm Brian Fouts up here in North Idaho, and it's been interesting. So if you guys saw me on WTF or Wealth Wednesday webinar today, just fair warning, I had food poisoning yesterday, so I didn't sleep very much last night. It's been a long day today so far, but it's been a lot of fun. So that was our first time talking about annuities on one of our presentations, and so I hope everybody got some good value out of that if you were on that. But we'll go ahead and go on the horn, and we're going to go to Mr. Mike Samet first.
Hey, Mike Samet here in St. John's, Florida, just outside of St. Augustine. So we have two annuity specialists, and I'm as well as IBC, the long-term care and IBC. So get the questions in. Move it over to the lovely Tess.
Hi, I'm Tess Hulek. I'm in Michigan, and all morning Brian was talking about bears in Idaho. I go on Facebook, and there are 2 black bears roaming around here. So you don't have to live in the country to have the bear come visit. And now down to Linus, because I'm sure he's got some critters at home too.
What at home?
Critters.
Oh, yeah. Hey, Linus Note here from Hopkinsville, Kentucky. Critters, yeah. I mean, we got chickens. That's about it. I downsized animal-wise just to kind of save on chore time. But we're starting to have more now that our kids are a little bit older and they can help do some of the chores. Today, I'm starting to put some numbers together for a church that is getting a policy on their pastor. So that's a very unique and fun use case to be part of a church becoming their own banker and protecting the legacy of their key people. So it's fun. It's somewhat of a new thing for me, but it's very fun.
We love that.
Go ahead.
Thank you, Linus. What's up, guys? All the Chris Noglers out there, all you financial warriors. Kevin Krause, upstate New York, not far from Chris, the team, and one of our favorite companies that we like to work with, Security Mutual Life. Former teacher, Army veteran, and retired first responder. And now I am helping as many people as possible, just like everybody in this team. It's an awesome group. And we're definitely here to answer any questions and hopefully get you started on your journey, or pretty much answer anything that you have, that has regards to HELOCs, velocity banking, infinite banking, you name it, something that we can solve your problem today and have some fun doing. So let's do it.
Yeah. And we have some questions that came in on Wealth Wednesday webinar that we'll cover here as well if we need to. But we got one question already from Shirley. Hey, Terry, how you guys doing? Let's see how it's here. All right. So Shirley is asking this question. She says, hey, team, my friend wants to quit her job. She just can't take it anymore. She has money saved up to live off of for a few months. Will it be a good idea for me to advise her to open up a policy to dump those savings in? Well, we can't give financial advice, but in a situation like that, from my personal experience, no, I probably would not put it into a policy because we want to have cash flow that's there from a job or a business, something like that, to fund the policy long term. Also, if she doesn't have any cash flow, the insurance company won't give you a policy because they want to see that cash flow, because the premiums, which are monthly or annually, they want to see some cash flow that's going to take care of those. But anybody else have any thoughts on that?
I thought the same thing, especially only a couple of months of income. You're making a huge jump. And again, we can't give financial advice, but I'll say I planned for a couple of years and I still should have waited longer than I did. And it wasn't around the infinite banking policy. It's that I hadn't replaced enough income to make that jump, but I was overzealous and did it anyway.
Yeah. The question would be what she's going to do.
Yeah,
that's what I was going to say. There are more factors to this. I would ask more questions to see whether it might make sense, but initially it doesn't really look like it would be smart to to do a policy for now. Maybe as soon as she starts another job, it could make a lot of sense to do then.
Yeah.
Yeah,
And
definitely.
the last thing I'll mention is that, I quit a job one time and didn't really have cash would replace it, but I had money to use. And so for me, it was a minimum 12 months of reserves available. And I was going into real estate. We were already making some money in real estate, but minimum 12 months for me. And by the way, as Tess said, I probably should have had 2 years. I probably should have waited and had even more because real estate is volatile. But yeah.
It's interesting because I know, Brian, both you and I have been listening to Tom Hegna about retirement. And he said COVID actually taught us all one thing. 6 months of reserves is probably not enough. It should be closer to 18 months to 2 years.
Or 5 in that case.
There you go, 5 years.
Yeah.
I like to keep 1 month's reserve in my policy cash value. Anything above that, though, I'm taking out and investing for a spread.
Yep, exactly. All right, so that was all the questions we got so far. I know that we'll get more as we progress, but go ahead and get those in there. But here's a question that came in from Deborah on the Wealth Wednesday webinar, and she says, "Can you put $100,000 in one policy at one time, or do we need more than one policy?"
It could be one, it could be multiple. That's really whatever you're trying to do, whether you're just trying to have one policy or if you're trying to get a policy on yourself and also your spouse or children, spread it out some. Both are options.
Yeah. And then I'd wonder, is she thinking it's a single premium policy, or is she actually going to use it for infinite banking?
I believe Deborah understands infinite banking enough, but because the other thing that you got to think about is the premium. Yeah. So if you put $100,000 into one premium or two policies, the premiums might be the same added together. It just depends on who's the insured person, because $100,000 is going to require minimum. I mean, you can maybe get by with $12,000 per year on that, but preferably 15 to 16 is going to be more efficient. But so there's also the corresponding premium. Could you do a lower premium on two people? Maybe, but it's not going to be significantly less, because $100,000 going in as a dump, and we call that, or a paid up addition, that's a very large amount at the very beginning. So you have to have corresponding premiums to support it.
So it's kind of like, hey, what's her purpose, right? What is her plan? Yeah. What's she kind of doing in the future to kind of support that, long term, but also short term, and try to make it work for her, right?
Yeah, well, that's on the webinar. That's what I did say is, we'd have to know what the purpose is of the $100,000. What are we trying to accomplish? What are we trying to solve with that? And then making sure that the plan fits that.
Our favorite word, it depends.
Yeah, yep. Definitely depends on that one. All right, Lori Howard's got a good one question here. Says, can you only dump in one time per policy? Because we have more cash we wanted to dump. Another policy question mark. So the question here is, can you do more than one dump in? We have more cash we want to dump in. And if so, if so, don't need another checkup, right? So she's referring to the medical exam. So who wants to take that one?
Well, I guess it would go ahead, Linus. Your specialty.
Well, starting with the medical exam, typically it's only going to be good for 1 year. So if it's still within the 1 year time period of when you first did an exam, probably don't need to do a new one. Although if you are getting, more insurance on the same person, you might cross a threshold where you still need to do something additional, like say maybe an EKG that hadn't been done originally. So there are some factors like that. As far as doing maybe another dump in on your existing policy, if it was set up and designed for that, it can. I'm a huge fan of doing that, to just have room for more premium in the future, have that option. So if it was set up for that, it can. If it wasn't, you may have to look at starting another policy, either on yourself or someone else in your family or a business partner. Sometimes it's even an option to go back to the existing policy and just have that option opened for an additional dump in. But some of these are just ideas I'm bringing up here. You should have a conversation with your money mentor and explore some of those options.
Yeah, there might be room in your existing policy for additional paid up additions. I would check with your implementation agent or the insurance company to find out.
Yeah.
Yes.
Yep, exactly.
Like those PUAs.
Yeah. So I have a client that has it's not similar to this, but it's kind of unique situation. I want to just go through here real quick. So I have a client who got a policy, got approved, it was issued. So it went in force. They drafted the premium, but the client paused signing documents because of a table rating. The client wants to go back and get the table rating revised because there was something in their medical records that said, oh, they had this. Client was like, wait a second, I don't have that. I've never had that. So they actually got a letter from a doctor, and the doctor says, yeah, you don't have this, and they wrote it. But the policy's been in force for like 3 months, but they have not funded their dumping yet either. It's a very strange situation. So Linus, on the application side of that side, do you understand kind of what happened there and why the insurance, they drafted the funds, but the client hasn't signed it. The client wants to get that table rating removed because it's not legit what they're saying.
Yeah, the insurance company should be able to go back into underwriting and potentially reissue the policy with that better rating if it comes out better. As far as what happened there, I'm guessing our team obtained the premium funds to place the policy in force before the contract was actually issued. So it got issued right then after that, and it was then sent out for the client to sign. So that's probably how that came about. I would just hope that they can go back. But worst case scenario, they'll just have to go into additional underwriting at the 1 year mark from when it went in force. So either one of those should be able to work.
Okay. Yeah, because I was talking to the client today, and it's a unique situation for sure. All right, so I don't see any questions in there, so we'll go ahead and go through some of these other ones. So a question someone had here is, how soon after the policy is in force can the ownership be changed? And then can 2 people be the owner?
2 people can be the owner, and it kind of works like any other asset or account where you kind of have multiple options. Either you have 2 owners and both have to sign off on any kind of changes, even taking a policy loan, or you have 2 owners and any one of them can sign off. So those are options. Typically, it is easier and just less hassle overall now and in the future for there to be only 1 owner, and also less. No, that's all I'll say on that.
Yeah,
changing ownership. You do have the contractual right to change ownership at any point. But in some cases, if you're trying to change the ownership right after the policy went in force because they wouldn't allow a certain ownership arrangement during underwriting, they would have the right to decline changing that ownership because that was actually something that had been declined during underwriting. So I do see that happen sometimes if that's attempted in the first couple of years. So I don't know if that's maybe what she's referring to or just something in general that came up.
Just asking. Yeah, because one of the other ways I've seen 2 people be the owners is through a trust arrangement. So the policy is moved into a trust. And I don't think the person was trying to get around it, but what they wanted was one of the owners, it was the whole insurable interest issue. And so they were trying to say insurable interest, but they wanted this other person to be able to access the policy, part of the family, by the way. And so they ended up having a trust set up with them being both members of the trust and parts of the trust.
Mm-hmm.
So that's another way to do it.
In that case, the trust ownership of the policy would still have to be specifically set up to allow any trustee to sign off, not just one.
Correct. Yep.
As far as timing, I got a policy in my name, and probably within 2 weeks, I changed ownership to my trust.
Yeah. Now, there's another reason why they don't like it being changed right off the bat, and that's for money laundering rules and things like that, or potential fraud or gifting money to somebody else. So they do ask that question. I've had it denied before because someone was trying to give it to somebody else, but there really was no insurable interest. But I was like, wait a second, but there's a huge amount of cash value in this policy, and you're going to give it to them. That's a gift, by the way. And so you got to be kind of careful about that because there are some laws and rules around gift tax and stuff.
They will ask the question. They asked me, why are you moving it so quickly? I said, I just forgot to put it in my trust. It was one time. Second time, I said I didn't have the trust created. So as long as it could be answered, they accept almost everything.
By the way, Mike, your microphone is a little quiet.
Oh, all right.
I did like the idea. I think I mentioned it earlier about the contingency, right? So if the owner passes away, then immediately it goes back to that secondary, owner, having that opportunity to be able to deal with that. So you don't have to worry about any paperwork and stuff like that.
Yeah,
Makes
definitely. Yeah.
Transition.
Yeah, you always want to have a contingent owner on your policies. I've heard
people get confused about that all the time. If you have a policy on yourself, there can't be a contingent owner because you're both the owner and the insured. If you pass away, the policy is out and it's done. There can't be a contingent owner. This only applies to the case where the insured person and the owner are two different people.
Yeah. I gave the example of like a juvenile policy, and you have one parent, the owner, the other parent should be the contingent owner of that policy. So if something happens.
Or like a grandkid, right? Like grandparent gets a policy on a grandkid, right? And then they pass. Maybe the contingent is, the parent of the kid.
Yeah. And Tess, you mentioned that you've heard there's some large amounts of death benefits unclaimed because of that issue where someone passes away, the owner of the policy is somebody else, but they've already passed away and there's no contingent owner, and the policy goes into the abyss.
Well, I think
you're talking about contingent beneficiary. Those are two different things.
Beneficiaries.
And it came up because somebody was saying on Ask Me Anything, what happens to that money? And for insurance companies, we report unclaimed property. So it's probably not even with the insurance company anymore. It's in the state, because by law, and that's something that's audited, anytime you have something like that, they have to send it to the state. It's called sheeting it or putting it into an unclaimed property fund.
Contingent beneficiaries. Right?
Yeah. So if they couldn't find them, that's where you go.
Yeah. All right. So Dave's got a question here. It says, if you get to the end of the policy year and owe interest on policy loans, is it better to roll the interest into the loan or pay it as a separate payment?
I think it was 2 weeks ago, Tess, that Craig had a really good explanation on it, talking about like the 4 different ways and how paying the interest or not paying the interest, and just to go back to Chris's YouTube channel example in there, David, there was a really good video, wealth webinar, that Craig definitely had some PowerPoints in there, but it sounds like you were going to explain. Go ahead.
Well, I was just saying on my policy, this renewed, or it had the renewal date. They actually rolled the interest into the loan automatically. So
yeah, they always do. They always do, even if you pay the loan interest amount, because if they send you the loan interest statement and you send them a check for it for the exact amount, they're going to receive that and just apply it as a loan repayment at that point in time whenever they receive it, whether you make it online or you send them a check, whatever you do. And so all that did is reduce the principal. And then on the actual anniversary date is when the interest amount rolls into the balance of the next year. So same thing. I would try to, if you can, it would be better to pay it as a separate payment. I will tell you that.
I always do that as well, separate payment. And I pay my interest every year because I don't want that to accumulate.
Yeah, I agree. Pay that interest every year.
Yeah, I went and looked at my policy. I was going to pay it, and it was only $110, and I was like, "How is it so freaking low?" I was expecting like $500, and it came in at 110. I'm like, I'm not even going to think about that. That's a small number.
Simple interest is a beautiful thing.
Yeah. Well, it's a unique policy though in how it was acquired and stuff. But yeah, it had a $7,000 loan for most of the policy a year. But yeah, the interest was a lot lower than I thought it was going to be. So I will take it.
Have you guys used the vault to be able to put in the numbers and actually see the difference? Like, hey, you roll it into the loan or you pay the interest at the end of the year. Have you guys been able to look at that yet?
I haven't done that scenario, no.
So yeah, in the software, you can kind of choose when you do like a loan or you do the loan practice, like, hey, I want to take out a loan. This is a percentage. Hey, I want to, pay down the interest at the end of the year, or do I want to roll it in? Right. So it's kind of just different options. That's really cool to be able to see. Technically, to pay it down faster is paying the interest at the end of the year, but how do we teach it? Having more control, putting it back in your policy every single dollar, and having it roll into the loan. It's a simpler way to do it, so you don't have these separate payments.
Gotcha. Yep.
And David, it's always great to have you here with us, you and June.
Oh. All right. Let's see here. Frenchie's got a question. Says, I want to start my infinite banking policy through a trust due to the unexpected death of my mother. Sorry to hear that. Who is the executor of her sister's estate. What is the process to replace her as the executor and move it into a trust?
Move what into the trust?
That was my question. So I'm trying to think. Yeah, what are you trying to get Frenchie into the trust?
I'm going to assume that BC policy. That's
Right, but what's that have to do with
the
mother and the sister?
Yeah, because she wants to start her policy so it doesn't exist.
So it sounds like there's a probate involved there with what you're saying, and that can really get drug out a long time.
Yeah.
If you're wanting to start a policy for infinite banking, if possible, I would probably just start it owned personally to at least be able to get started, and then whenever the trustee arrangement is right to move it into a trust, then you can do it.
Yep. Yeah, I'm not sure about that one. So, because of a trust is mainly, by the way, for estate planning and probate. You can't do a trust after a death, by the way. So,
yeah, somebody in the comments is saying she's talking about the estate.
Yeah,
it's.
So I guess here's another question that they might be asking. Her sister's estate is over here. Now you've got the mother who was the executor of that estate. Now the mother passed. What's happened to the sister's estate right now?
Right.
Because you can't move an estate into a trust because it's already in probate.
Yeah.
The trust has to exist before that.
That's
sounds like stuff she's got to figure out with her sister, right?
Well, it sounds like her
there's no sister anymore.
Passed away too, because there's an executor of that sister's estate, and well, generally those probate arrangements are going to have a contingent executor in case the executor.
Oh, it's not in probate. It's not in probate. That's the thing. Okay, so Frenchie's saying so the sister's estate is not in probate. Mm-hmm. Now the mother has passed. So the question is how do you replace her as the executor and move the sister's estate into a trust? So that's pretty simple on the sister's side of it. Just go create a trust with the sister. That's you'd have to have it set up. Now the question I think is if your mother has an estate now, is that in a trust? I don't know. And then I don't know what the process is to replace the mother as an executor. It depends on what she has set up, because I'm trying to remember how I learned this many years ago. Oh, the sister is deceased as well.
Yeah. If there's an estate with an executor, she would have to be. It must mean that it's already through probate or something. Yeah. But yeah, moving it into a trust. There should be a plan with a contingency for executorship.
Yeah,
that's really the only thing that could be done there that I know of. And if there's not, the whole thing's got to go back into probate court, I would guess. But I'm not the legal professional there. You want to be working with an estate attorney there.
Yeah, check for executors there. I have like 3 in line, and the third being an actual company that will always be in existence.
Yeah. We have someone that we can refer you over to that has the attorneys that can go through that with you. But that's really the next step, is to talk to an attorney, because we're not attorneys. So I would just talk to an attorney and they can work with you on that. So definitely reach out to us, and I'll put in like my email address if you want to reach out, and I can do an introduction to one of our team members, one of our partners.
So I just got an awesome piece of news, something that's been worked on for probably about as long as I've been doing this, for years and years. One of the insurance companies we work with has always, which they all used to do this, but they were one of the last ones that still delivered policies on paper only. So it was a longer, tougher process, and they've been working on doing e-delivery like most other companies, and it is finally live. We've used it for the first time today, and so that's really awesome. It's going to make a lot of things go faster and easier.
Oh yeah, for all of you guys in New York.
Yeah.
I had someone, a New York client, asked me the question about infinite banking, and I was going through this. He goes, I don't want to use. I want to use this company. What's the best thing I can do? Move.
I knew you were going to say that. Move.
Yeah, move. That's what I told him. But I actually did have a client that actually did go get a change of address, got a different driver's license, and because I think they had 2 houses or they had a relative over here. They actually literally went through the whole thing to change residency so they could work with a different company. Yeah. So
Yeah, it just doesn't make sense to me because
Overachiever.
this other company typically outperforms the other ones. So I don't quite make sense of that.
Yeah, I agree.
But
part
it
of
all
it
depends.
Linus, part of it was age. Cost of insurance was astronomical with that company, astronomical. And the number, it just wasn't quite penciling. And then we did the illustration with another company. And of course, it penciled quite a bit better. That was why. But it wasn't hard for them to go change everything over.
What age was that?
Late 60s or early 70s.
Oh, okay. Yeah.
When you're in the numbers, it was
a lot better. They have some changes coming. So that's something we're excited for later this year too.
Really? Okay, very cool.
Yeah, they have some significant changes coming that will make that possible again.
Yeah. And another question I got from someone here says, is there a point where you can get a policy, but you would not, and they're talking to me, said Brian, that you would not recommend it for a person? I said, well, there's lots of reasons why, but they said if everything else works, why would you not recommend a policy? And so I want to share this one. This is the first. I'd only seen this one time so far. They were approved. I can't remember if they had a table rating or not. They did. They had a table rating. The death benefit was less than the cumulative premiums. I didn't even think that was possible, but with a table rating, it is. And I can't remember what company it was with. Doesn't really matter. But yeah, at the very beginning, it was fine. But then as time went on, the death benefit didn't grow very fast. The premiums grew, of course, or added up. And all of a sudden, the death benefit was less than the cumulative premium. And I was like, I would not recommend this. This makes no sense.
Right.
And so we, on that case, we did a policy on the other spouse. So yeah, that was the first time I'd seen that.
Generational wealth, right? And that definitely not giving generational wealth.
Yeah, that was definitely not it. Okay, so here's another question that came in on Wealth Wednesday. Someone is asking, can I get a policy on my husband if he has criminal history? Now, I don't have any details on the history.
Potentially.
Depends on the
type. Yeah.
There's a good chance that they could. It just depends on the severity and the timeline since and some of those things.
And even the company, right?
Yes, that's what I'm saying. We have some companies that can offer more aggressively on stuff like that. So there's more possible than you think sometimes. Yeah,
let us know what it is. We can check for you.
Yep, that's the whole thing. Is we got to know the severity, the degree, all the kind of stuff, the type, time served, all that stuff comes into play. And the other one that can really hang people up is DUIs. So I've had a client that had, this was like 30 years ago. They had 3 of them. They can't get they wouldn't give them a policy right now.
Yeah. One company would though, unless there's been something since then.
I don't know. This was a while ago. I don't remember what it was, but yeah, they got denied multiple times, and they were denied before they came to us. So I think there may have been more to the story.
Yeah, I was going to say 30 years ago. I mean, that's a long time, right?
Yeah. Well, and as far as the criminal history, it's also come up, and this came up on a minor where the minor's records were locked, because they were under the age of 18 when this all occurred. They got denied because the insurance company could see the records. And I found out what the records were, and I was like, oh my gosh, yeah, that's not a good idea. Good. So the person was 21 years old at this point in time. So not enough time had passed either. So that's also a big part of it.
Yeah. When it comes to criminal history, another important parameter is how much time since probation ended. If it has only just ended or maybe still in probation, that's probably not going to be considered. A lot of criminal history, if the probation needs to be at least 1 year since it ended, or something in that line. So that's another piece of it to be sure to have ready to tell us that we can use to go check around for you.
Gotcha. Cool. So Terry says, I'm moving to Idaho from California. I can't take it anymore. What is it?
Lease.
Yeah. What is it you can't take it from California? Or what's the list of things? Because I used to live in the Bay Area, and that was 20 years ago, and I cannot imagine it's improved from when I left. It was brutal down there. But
or is Terry another billionaire leaving California? Right?
Yeah.
Because of the taxes.
Yeah, leave the taxes there, and leave the. I'll be honest, just me, my opinion. Leave the politics there as well.
Right.
Don't bring them here. All right. So another question we got on Wealth Wednesday webinar is, do you pay taxes on annuity income? So, Tess, you want to cover that one?
Well, you do pay taxes on annuity income.
It just depends. So it definitely does depend on how the annuity was funded.
Oh, okay, yeah.
Yeah. So if you fund the annuity with post-tax dollars, there's going to be a blended rate that you're taxed on. So you won't be, if like, let's say you fund it with post-tax dollars, and then you're taking $1,000 out, or you're getting $1,000 of income, a certain percentage is going to be a return of premium, and so is not taxable. Then you have an amount that is the gains or whatever that is taxable, but there's some other formulas. But the bottom line is it depends. If you fund it from a 401k or an IRA, then it's all going to be taxable when you take it out.
Yeah.
So, yeah, depends on how you fund it. But thankfully they don't do double taxation on them. Yeah. Also, Twin Falls. So yeah, Twin Falls, Idaho. That's obviously south from me, but nice area. I've actually been there in Idaho. It's funny. There's Post Falls, Idaho Falls, Twin Falls. I don't know how many falls there are in Idaho. So that's a lot. But car registration, I'm not sure what that means. Taxes, all the kind of stuff.
Yeah, because wasn't there Montana didn't charge certain fees for cars, so people were registering. So maybe she's asking about that for.
Oh yeah, I don't know about that. Yeah. I mean, I don't understand taxation of vehicles when you sell them, because it's you've already been taxed when you first bought it, then you're taxed again and again and again. It makes no sense to me. I always thought that was like, it makes no sense. But all right. So Anthony's got a question here. It says, it probably varies based on company, but how is income from stock trading capital gains counted for qualifying for a whole life policy and a HELOC? So anybody want to take that first part of that question?
Says company.
So he's asking about how is income from stock trading capital is counted for qualifying for a whole life and a HELOC?
Yeah,
So,
any and all income can be used for qualifying for the whole life policy, gross income before taxes, before expenses, before any deductions, anything like that. And that would include, rental income, other active and passive income. So stock trading and capital gains, that would be included. When it comes to a HELOC, that's through a bank. So and that's not us. And so their things vary a little bit more. I'm not sure how they rate that. Does anybody here know?
Oh, they're looking at your tax returns. So
Right.
if you're claiming on your tax returns, it's going to be there. There you go.
Yeah, that's something I should mention. They don't typically look at tax returns for the whole life policy.
Right. They'll glance at them, and then if there's a huge discrepancy between what you said and the tax return, they will definitely ask. So I had that happen here recently where someone claimed an income of, I want to say it was like $75,000. The tax return showed 30 or 15 or something like that. The insurance company says, hey, there's an issue here. Why is it so different? And come to find out, it was because the other income was under the table. And the insurance company's like, nope, that's you can't do that unless you want to claim it on your return. And the client was like, no, I can't do that. And they're like, well, I can give you a policy because there's something not right in that situation. So that's unique there. And then, as far as a HELOC, they're going to look at your tax returns in most cases. So if you're claiming it there you go. And then, is there a certain number of months or years necessary, or only certain types of gains that are counted, etc.? Well, with the whole life, they're really, you're going to tell them how much you make. Yeah, they're going to ask you. You're going to tell them. if your policy gets to a certain point and Linus knows these numbers, then they're going to start verifying income and require verification. But that's when the policies get up into like the $1 million death benefits or higher sometimes. Linus, do you remember what it is?
It's generally when you're north of 5 or 10 million.
Yeah. So they're going to start to verify that. And every company is going to require certain documentation or records or that kind of stuff. Or they're just going to want to talk to you about it. And then as far as certain types of gains on the whole life, as Linda said, it's all gross revenue. So the HELOC as well they're not looking at gross revenue. The HELOC is going to more look at your taxable income. Mm-hmm. So they're not looking at your business income, that kind of stuff. They're looking at your income. You declare like W-2, self-employment income, all that kind of stuff.
And another reason why we like the policy so much, right? The strictness is way more stricter with the bank, right? With the information you give them, all the information that the insurance company, or should I say the bank, is requiring, right?
Yeah.
Versus the policy, you have a lot more room, a lot more freedom, a little bit. It's a lot easier to get versus the HELOC, the bank. I mean, I'm sure the person, if they're talking about a HELOC, they probably already got a mortgage. So more than likely, they should already, know what they're going to require, because they already had to do that in order to get a mortgage. It's just another step of doing it through the bank.
Yeah. Now, in the HELOC space, just keep in mind that is a bit different than like going to get a mortgage, because most banks will give you a mortgage, but not all banks will give you a HELOC. And every bank has certain qualifications for a HELOC. Most of them are going to be very similar to a mortgage, by the way, and maybe even more strict. But I have I'm working with a bank right now. My tax returns for the last 5 years show zero income or a negative amount, adjusted, of course. So a traditional bank's not going to give me a mortgage or a HELOC. But this bank, which they specialize in HELOCs, all I gave them was my bank statements, which show my income. And they can use that in place of the tax returns. So, and I just found that out, and it was an awesome process, a lot simpler. So,
nicely done there, Brian, with your taxes.
What's that?
Nicely done with your taxes there.
Well, it had to have some things not work out that I wish had worked out, to be honest. But yeah, it was interesting. But I'll tell you this, and I've said this publicly before. I think maybe on last week. Last year, I had a negative year because of a business I shut down, by the way. So I paid no federal income tax. The federal government, the IRS, by the way, sent me a refund check. I never sent them a dime, and they sent me a check.
I've had that for every year since I've been married.
Yeah, it makes no sense. I'm like, how do you function as a business? Oh, that's right. You're not a business. You're politicians in the government. They are. It's. I mean, so inefficient. It's mind-boggling. But yes, there we go. All right, Anthony got a follow-up question here. Says, if gains are in an IRA, would it be harder then for them to qualify for a HELOC? Well, yeah, because that's not income.
Yeah.
Yeah. So it's not even part of the HELOC conversation because it's not income.
Yeah.
So, but once you take it out of the IRA, like a 401k, you're getting distributions, that's income. So you'd have to take the money out of the IRA for it to be considered income, because that's going to be on your tax return, all that kind of stuff. So yeah.
We may be able to use it to qualify for the whole life policy, though, but that's going to be a case-by-case basis. And I mean, yeah, we need to have a conversation. Maybe you don't even need it in order to qualify for the type of policy you're looking for.
Right.
Yeah. Yep. All right. Hey, Irv, you were on the Wealth Wednesday. We have a call scheduled here, I think, tomorrow. So as when discussing retirement options, I think you mentioned whole life annuity is better than variable indexed annuity in the webinar. Is that only because of the risks being tied to the market? So there's not a whole life annuity. There's whole life policies and an annuity. They're two separate things. But you have different types of whole life and different types of annuities. You have indexed universal policies and indexed annuities. So they're both, if they're indexed, are tied to the markets, and they're going to be variable. There's going to be ups and downs. There's going to be potential risk with those kind of things. We don't touch any products that are indexed. Even annuities, we don't really want to touch those either, because there's not certainty there. Like, we want to have certainty around our money. We want to know that, hey, if I'm making $1,000 today, I'm going to make $1,000 or more 5 years down the road. With an indexed product, that's not there. Also, which one's guaranteed? Anybody want to touch on the guaranteed? the guaranteed aspect? So is an IUL guaranteed?
No.
No. So the growth is not guaranteed. The death benefit of an IUL is only guaranteed if you die while it's still active, but it can go to zero. You can lose an entire IUL policy. And I have had them before, and I have looked at the illustrations, and it shows what year it will go to zero.
Yeah.
And that's even if it performs as good as possible, it'll still go to zero. The agent that set that up for me never explained that, never showed that. It was years later that I ended up finding that out. Yeah. So, but also with annuities that are indexed as well, you're going to get income no matter what from them, but it can vary. It can be up and down. And so if you're in retirement and the market crashes and your income goes down, that's the exact opposite of what we want to have happen. You do not want that to have happen to you. So anyways, I could rant on about those for quite a while, but yeah, we don't touch the index products. Anybody else want to chime in on that one?
No, I agree. We don't touch index. We like those guarantees.
Yeah.
Nelson put it right in his book, right? You know, Become Your Own Banker, talked about, hey, he tried to do them. He ran them. They always, you know, when you got older, they always blew up or wouldn't work properly. You know, yeah. My family, we started out with 2 of those. And again, as we continue to learn more and read and got involved with the Nelson Nash Institute, we learned that, you know, just the dangers and how, I think it's Chris and all the other Chris, Kilpatrick, I believe.
Patrick, yeah.
Right. They're the ones that have that $10,000 challenge to, you know, anybody who's got a 10-year policy, you know, that's an IUL. And hey, let's see if it'll match or maybe do better. And to this day, nobody has come forward to actually show that. Not to say that there isn't one out there, but pretty unlikely because it's been a few years. Nobody has come forward to show one. So, hey, why wouldn't we want to put it into something that we know it's been around for, you know, over 150 years versus a product that's been only around for 20 something years, right? And has a lot of issues and has, you know, some of them have blown up or fallen apart.
Oh yeah.
When you need it the most, right? When you die, right?
I always tell my IBC clients, if you want market exposure, take your policy loan and put it into a mutual fund, ETF, or stocks.
Yep.
At least you can control that and that risk.
Yeah.
But the policies, like Tess said, we want guarantees. Can only go up in value.
And that's why we say it's the and asset, right? We can do both of those things, right? Be able to invest and have our guarantees and have our death benefit and have control at the same time.
Because one of the questions I always ask people is, do you want certainty around your money in the future? No one's ever said no to that question, by the way.
Yeah.
So, okay, then why would you ever do an IUL? Like that's my next question. Why would you ever do that? Because I ask people, I says, well, do you have money in a 401k? Yes, I do. Do you like it being there? No, I do not. Then why do you have an IUL? Like it's kind of weird. They're all kind of in the same lane. So anyway.
And we've often talked too, look up lawsuits for IULs. There are a lot of them out there, and that would tell you that either they didn't understand or I'll say they didn't understand. I'm not going to assume that they were lied to. I'll just say they didn't understand.
Yeah. Kyle Busch. Look up Kyle Busch.
Yeah. Kyle Busch is a huge one to take a look at.
And high commission.
Yeah,
Right? Super high commission.
But also, and this is the last thing I'll say on this one, when the markets change, because right now we're in a very, very weird space economically because the government has manipulated the markets and other people have manipulated the markets so much in the last 15 years, we have not seen a market like recession crash like we'd expect. When that does happen, look at the IUL market. I think it's going to be bloody. So, yeah. All right. So Sherry has a question here. Says, team, I have an IBC policy and the only debt I have is my mortgage, which is 2.69% interest rate. My question is, should I pay off my mortgage using my policy or use it for investing instead? Well, one, that's financial advice. So we can't give financial advice. But if I was in that same situation, that's a pretty low mortgage rate. Even though the actual effective rate is not 2.69%, it's going to be more like 8% or 7% compared to a simple interest. It depends on how much you have in the policy. It depends on the cash value, and it depends upon your ability to invest. So there's a lot of factors.
And how long have you had that mortgage?
Exactly.
A lot of
The interest on it.
Yep,
Yeah.
yep, exactly. Yeah, if she's had it for like 10 years, let's say, then obviously that high interest is kind of toward the wayside. There's still a good amount of interest, but obviously the first, 7 to 10 years, right, is that high mortgage interest, right? Once you kind of get past that point, it's kind of getting to where the interest and the principal payments are evening out, and then it becomes higher in the principal and lower in the interest.
Yeah. I mean, it depends upon what the overall goal is too. What are we trying to accomplish here? Are we trying to build wealth, get rid of the debt? What's your focus? Because that can really help. Because you can go and invest the money. That's something you can do. Create cash flow. That cash can go to pay the mortgage off faster. At the end of the day, mortgage is gone, and you have the asset. If it's a long-term asset, you still have that. And you still have the cash flow, still have the wealth. So it just really depends upon your situation. But the last thing I'll mention is, do you understand velocity banking? Have you looked at that concept? Because if you start looking at that concept, all of a sudden, if you have equity, there may be other ways you can pay off the mortgage faster and put the policy to work. Do both.
Mm-hmm.
Get rid of the mortgage and invest. But once again, we'd have to have a phone call to really understand your situation and what resources you have and all that. Okay, well, that was all the last question we got over here. Let's see here. Oh, yeah. So this is an interesting comment that came in from Carrie Swanson on Wealth Wednesday webinar, and she said her husband has a pension. So pensions depends on who they're through, but teaching career, the pension is only about 1/3 of what they said it would be when he started teaching.
Ooh.
Yeah. You saw, the only thing I'd be curious about is beginning when you first start out. I mean, you're really not going to know what your pension's going to be. I mean, could you calculate it, I guess?
They'll tell you. There's a formula. Yeah, so there's a formula based on your income that they will tell you, hey, if you do this for the last 3 years of your highest income earning years, is going to dictate your payments, all that kind of stuff. But what I'm guessing happened is the pension did not perform, or the employer or whoever did it put it into something that did perform. I've seen that happen. You've heard about the horror stories of pensions that gets mismanaged or fraud happens and all of a sudden it's not there. You were out of luck.
And here in Michigan, it's been a while. I probably shouldn't even admit this, but our pensions for the city of Detroit were all messed up when we went into bankruptcy.
Mm-hmm. Yeah.
So there was that period of time. And I do know this is a Michigan person as well.
Okay, yeah. Mm-hmm. Yeah, so that's the challenge with those because it depends on who your employer is, how big the employer was. My dad has a pension, but it's from the state of Washington. They have money. They can print money. They can make money. They can tax people more, which they just did, by the way. But when it comes to an annuity is a self-funded pension. But they're also with insurance companies. And historically, a lot of these insurance companies that do these pensions, they're very profitable. They've never lost money. They've been around for a long time. So if I had the option of leaving my money in a 401k, me personally, I'd take it out of the 401k and put it into an annuity because it turns it from a variable or up and down volatile strategy to a fixed guaranteed strategy.
And the insurance industry is highly regulated, high oversight.
Yeah. That's crazy. And I wonder, I don't know. You can't really take money out of pensions. You can in some situations, I know, but it depends on the structure. But I have heard of people that have a pension and they're looking at this thing saying this is not good, and they'll take a huge lump sum out of it and go do something else. I've had a client that did that for a policy, by the way.
Yeah, they need to find out the rules for their particular pension. That's going to take research.
Did they say what state that they lived in or what?
Michigan.
Well, Carrie's Michigan, yeah.
Yeah, Michigan.
Okay. But yeah, I'm going to assume every state's going to be a little different. I know the New York State teachers, their pension system is like one of the largest ones in the country or whatever, as far as funds go. We get reports or whatnot sometimes in the mail.
And I don't know if the teachers were impacted by Detroit, but a friend of mine worked in for the city of Detroit, and they got 30 cents on the dollar for their pensions when the city went bankrupt.
Ooh.
I know they are talking about the different tiers, right? Depending on what tier you're in, a lot of people that are joining now are in this higher tiered, so they have to put in and contribute for their entire career, versus some people, you know, when I started, you know, teaching back in 2001, it was kind of more, hey, you put in for 10 years, and then after that, you don't have to put in for any more. You know, so when you retire, then you just collect off of it, right? So it's definitely different state, different organizations, different pension systems.
Yeah.
You know, all that stuff.
Yeah. I mean, people are living longer too. So you got to keep that in mind. So now these pensions have to pay out longer than they would, you know, 30, 40 years ago, which still blows me away with Social Security. How they have not changed the structure of that thing in decades just boggles my mind. I just don't understand it. All right. So Irv had another question. He had a question on the Wealth Wednesday. He's on this right now, but it's a good question. So he's saying, if selling a home and looking to 1031 exchange the proceeds, can infinite banking serve as the vehicle for proceeds to avoid capital gains?
It sounds like the 1031 exchange is going to be your vehicle to avoid capital gains tax. But
real estate, yeah.
We're not licensed tax professionals over here. 1031 exchange. When you do a 1035 exchange, or at least when you do it right, my understanding is that the proceeds have to go in a holding account with the attorney. What are those things called? Escrow. Escrow in between, and so you wouldn't have the opportunity to go put it in a policy in between, to my understanding.
Because it has to be from a like investment to another like investment. It has to be real estate to real estate. That's what a 1031 is. You have a 1035 exchange, which is insurance to insurance. So moving cash value from one policy to another without any taxable events. So that's a qualified strategy right there. A 1035 is a qualified one for that transaction. Going from a real estate to life insurance is not a like-to-like strategy, so they will not let you do that. You got it. My understanding, once again, we're not attorneys, got to talk to a tax attorney or tax professional, but you have to receive the proceeds first, cash in hand, and then fund the policy. But that would create a taxable event in most cases.
If it's your personal residence, you have it at exclusion. I think it's 250,000 single, 500,000 married.
Yeah, I've done that before. Yeah. But yeah, so it depends on what you're trying to do, depends on the property, who owned it, all that kind of stuff. And then one other question here, this is a good one as well, says, what is insurable interest? So anybody want to cover that one real quick?
You can look it up and read about it. It's going to be up to the underwriter really to determine what insurable interest qualifies. But insurable interest itself is, if this, say you've got an example, it's your brother. If that person passes away, what financial loss are you going to have? You know, was his income helping to fund your lifestyle too, or, you know, some arrangement like that? Were you business partners with him? That's a example of insurable interest. Generally, it's going to be when there's a financial loss if that person were to pass away.
Here's a question I have on that one. What if you're the godfather to a newborn and you want to get a policy on the parent, so in case they pass away, you have financial means to then take care of the child?
So the godfather getting a policy on the biological parent?
Yep.
Yeah.
I mean, there would be a financial impact if they passed away and you had to take on the care of a child, because there's expense associated with that. I mean,
yeah, well, there's two biological parents, so
they both die.
It would be a case-by-case basis. I would get some details and ask the underwriters about it ahead of time. It sounds like there should be an insurable interest there, probably just a small one, because if they're not really being a super direct relationship there, but I think there should be.
Yeah. I was kind of curious about that one. And then as far as the insurable interest goes question, could a charity or a trust qualify?
For what?
Insurable interest. So what I think they were asking originally is if a trust or a charity can own a policy on somebody else, do they have insurable interest there somehow?
Oh, yeah. Well, I mean, I can start with the charity. If say you are contributing, you're gifting $50,000 a year to a charity. Well, that constitutes an insurable interest because if you were to pass away, that $50,000 a year dries up for the charity. So they're typically going to allow the charity to get a death benefit of 3 to 5 times, somewhere in there, sometimes even up to 10 times the annual contributions that the person is contributing. And that would work the same way for a church. But then for the trust, there's a ton of different ways that it can be done. There is it a family trust that is set up to purchase life insurance on everybody in the family, or what's the deal?
Yeah. On the church one, Linus, who owns that policy?
Well, there's different ways to do this. Somebody could have their own personal policy and then just designate the church as the beneficiary of it, or a percentage of the beneficiary position. That would be one way. But in the same example as the charity there, where the church or charity could own it and pay for it, and then they have control over it, cash value, and then they can also be the beneficiary. That would be another way to do it. It's also possible to just gift the ownership of a existing policy to the church or charity. Not always a smart idea, because churches and charities generally are going to be looking at it as like, well, the policy is worth this much. Free, let's cash it out. We need the money. And they just don't have the long-term thinking in order to hang on to that policy. Maybe use the cash value now for some projects and wait for that much larger death benefit payout in the future.
Gotcha. Makes sense. Yeah, because I started the process. We've never finalized one on a church yet. They were trying to they wanted it on the pastor, but they hadn't even explained the whole concept to the church yet, to the pastor. They didn't even know about it yet. So I'm like, well, you got to go have that conversation with them, and it has to make sense to them first, because they've got to fund it. The church has to fund it.
Church board or somebody has to sign off on it.
Yeah, and so that one didn't really go anywhere. But there's another one. Oh gosh, that was a large church. I mean, the pastor was, his salary was over $250,000 a year. It was a mega church. And they had the amount of money that went through that organization was staggering. But they also, what they did in that local area, and the outreach, the charity they did, it was amazing, really cool. It was actually some friends of mine years ago. Well, cool. Well, we made it to the end of Ask Me Anything. Appreciate all you guys being on. Appreciate the questions. Anthony, thanks for being here as always, and everybody else. So keep in mind, guys, we do these things every week. So make sure that you are here every week. If you have questions, make sure you bring them here to the group. And with that, any parting words from everybody else?
Bye-bye.
Yeah, stay safe and enjoy the week.
All right, guys. Take care.
Good week. IBC.
Oh, look at